Understand credit risk under Basel IV. Basel IV aims to increase risk sensitivity in standardized approaches and enhance comparability by limiting internal model use. These objectives are crucial for ensuring the stability and resilience of the global banking system. The revised credit risk framework poses significant challenges for banks, particularly in the Standardized Approach for Credit Risk (SACR). To understand the impact of the reforms, you need to know the following. Almost all exposure classes have undergone fundamental revisions, reflecting the Basel Committee for Banking Supervision's efforts to address weaknesses in the existing framework. Reasons for changes in SACR under Basel IV are multifaceted, including reduce mechanistic reliance on external credit ratings by requiring enhanced diligence. Reduce the material variance of capital outcomes of internal models, which makes banks less comparable. Improve granularity and risk sensitivity on several exposure types such as retail and real estate. Use the standardized approach as a backstop to capital requirements such as the output floor. The desire for increased disclosure requirements. Cutback of the number of national discretions to increase comparability in capital requirements. Changes to the standardized approach for credit risk under Basel IV encompass various elements, including new risk weights for most asset classes, more detailed risk weightings for certain categories of exposures, including project finance, residential, and commercial real estate, higher granularity of risk weights for mortgages, mostly depending on the loan-to-value ratio, new methodologies for bank exposures, using either external or standardized credit risk assessments. A more granular approach has been developed for unrated exposures to banks and corporates. For rated exposures in jurisdictions where the use of external credit ratings is permitted, additional due diligence is required. Basel IV amends the criteria for recognizing external credit assessment institutions by regulators. Note the following. Revised general principles for banks are introduced to reduce mechanistic reliance on external ratings. Requirements to perform due diligence on all counterparties at least annually. Need to assess whether external ratings are producing appropriate risk weights. Applicable rating agencies include S&P Global Ratings, Moody's, and Fitch. The Basel IV package has rewritten risk-weighted assets, RWA, frameworks for the Internal Ratings-Based Approach, IRB. This revision is expected to enhance the accuracy of the risk measurement methodology and reinforce the stability of the banking system. Major changes include removing the option to use IRB for exposures to financial institutions and certain large corporate exposures. Removing the option to use IRB for any type of equity exposures. Introducing floors for inputs such as probability of default, PD, loss given default, LGD, and credit conversion factor, CCF. Providing greater specification of parameter estimation practice. These changes reflect the evolving nature of credit risk and the need for a more nuanced approach to its measurement and management. The Credit Valuation Adjustment, CVA, was introduced during the 2008 to 2009 global financial crisis and will change under Basel IV. CVA measures the difference between a risk-free portfolio value and the actual value, considering counterparty default risk. In other words, CVA is the market value of counterparty credit risk, CCR. Basel IV replaces internal models with a new standardized approach, SACVA, and basic approach, BACVA. BACVA includes two options, basic reduced CVA approach and basic full CVA approach. Expanding CVA to fair-valued SFTs is expected to raise capital requirements, especially for firms with large SFT portfolios. Clearing derivatives through central counterparties can exempt banks from CVA requirements. SACVA includes a wide range of hedges, aligning capital with economic risk. This shift in framework is significant as it promotes a deeper understanding of the underlying credit risks associated with different exposures, thereby improving the overall robustness of the regulatory framework. Thank you for watching.